enthusiasts right around the world. Thanks a lot for joining me on this Thursday afternoon market recap. We have seen some very interesting movements. Really post the Fed announcement, the market has been rather bifurcated. We're seeing tech really take off and continue to the upside. However, the Dow Jones Industrial Average and the S&P 500 are rather stuck in the mud at this particular point. We are seeing that of a sort of a dichotomy in movement. And really this recording is going to drill into that, the explanation as to why that is happening. Also, we are going to move into a bunch of individual trades and give you some updates as to what is happening, not only in our top 12 individual trade list, but also in this external list that we have been following over the past number of weeks. One to mention, of course, is JD. JD today up another 6%. That individual trade has turned out to be rather remarkable. It's been rather extraordinary too. And I mean, as at the current juncture, if I can just bring it up for you, I'll just show you today's candlestick. Ooh, if I can bring up the right chart, JD. You can see for yourself, volume is flooding into JD. It was up another $2.50 from the breakout entry here at 37.22. The net movement so far is 17.5% on the equity price rising in the space of entry. And also, if you take into consideration the utmost, or at least the best possible entry price that we were looking at 36.12, the percentage return on that equity is now approaching, or just over, 21.1%. Now, that is, of course, notwithstanding the option price or the movement in that underlying option contract. Personally, I trade options, and the majority of people that I speak with and listen to that pro recording, they are option traders. And when you start talking about equity movements in the vicinity of really 10% movements, generally I'm pretty happy when a stock or an equity actually moves 10% away from our entry price. When you're looking at that, generally you're looking at an option return of over 100%. But when you start talking about the ballpark vicinities of 17.5 and 21.12, especially when that delta really starts to approach, or at least moves above 0.9, and you really start to see the transformation of that option contract in the dollar incremental moves with the underlying share price, you really start talking about, or at least referencing, some rather astronomical returns, or at least percentage returns relative to what we sort of bought those option contracts is. And this is dating back really to the beginning of May. So a lot of people right now are really being paid off in JD. I'm very happy about that, and I didn't mean to actually speak about JD at this recording, but I had to mention, I mean, when you see these movements, it gets us all very excited. But at the same time, I think it's a good idea now to be potentially leaking out, or at least taking a position or a portion of those initial contracts off the table. I mean, again, it's far exceeded that 10% general sort of rule that I like to trade with, or at least when a stock moves 10%, I say, well, it's always a good time to be taking positions off and culling positions. But at the moment, we've more or less doubled that. We're approaching 20, and don't be sort of swept up and caught up in the emotion of JD. It has been a fantastic trade. You can see for yourself here, and it's a good example, or at least a good time, in my opinion, to be humbly taking some contracts off the table and to be banking some of that profit and putting it in your back pocket. So that, I should say, will cover JD. I'm not actually going to return back to this. I think more or less you can see it just comes down into trade management. So you can more or less, if you want to, if you don't want to take any trades off the position, just lock in the profit below that of the intraday move today. That will be coming in at about $41 per share. However, understand that the difference between the closing price and the open price more or less is around 6%. So it is a fair amount when you're talking in terms of options, let alone the actual equity price as well. So now that I've sort of hit that on the head, I want to move into the NASDAQ. Of course, I mean, I should just say in full disclaimer, I'm going to go through the US equity markets, Netflix, Google, FTX, HD, TWX, the US dollar, which went parabolic today, and I will touch on GLD. And of course, there may be a couple of other stocks, probably Apple, Amazon, because Amazon's breaking out. Apple's sort of stuck at the moment. But again, it is going to be sort of a longer market recap. If you have any questions, by the way, email me, success@pivotpoint-trading.com. I encourage anyone and everyone to email me with any questions, concerns, queries. I mean, I'm more than welcome to reach out and always respond to you. So you can always take advantage of that as well. If you wanted to get personally in contact with me, you have my email address below this particular video, as I've already mentioned as well. So getting back into the nuts and bolts of the analysis, you can see for yourself the NASDAQ continuing up 65 points today. Yesterday, we were left with that of somewhat of a shooting star candlestick. I was saying yesterday that it's not textbook. If we really want to be somewhat creative and sort of stretch the analysis, you could say, well, we do have an upper wick, and the upper wick is pronounced. However, today we've just completely disregarded that, and above all else, we're just continuing in the actual trend direction. You can see that we're holding above the exponential moving averages. This, of course, is after the breakout that happened really in the first trading session of June. This has taken me a little bit by surprise, and really what this is laying, I guess, the platform for is ultimately the industrial average and the S&P 500 to rally and more or less not catch up necessarily to where the NASDAQ is, relatively speaking, but it does lay the platform again for the Dow and the S&P to come on up and close this open window. This has been the narrative and really our position on the market for quite some time. As soon as really we saw the bottom of the sell-off dating back to the beginning of February and the 2 consecutive retests post that initial sort of support area, this has been continuing to act as a magnet, and it's really been guiding us, one, in our trade direction for our underlying top 12 list, but also when we've been looking for other sort of opportunity outside of this top 12 list. So sort of like that PayPal trade a number of weeks ago. And as I just sort of recapped before, JD as well. So you have to understand that the trend direction of the market is up. Now, as we look at the Dow Jones Industrial Average, you can see where we're starting to see a little bit of bifurcation, or at least divergence between, I guess, the sentiment which is roaring in the NASDAQ and currently sort of, this quieter sort of period that we're seeing in the Dow Jones Industrial Average. Now, what this appears to be happening, or at least playing out as, is that of a bull flag continuation. So it looks as though the Dow is resting. It's resting above the 10, the rising 10 exponential moving average, which is technically a very strong signal. And generally what will happen is if the NASDAQ continues, or even if the NASDAQ treads water, what you can expect is that at some point we're going to see a market reaction, not only on the industrial average, but also on the S&P 500, which is going to continue to push the trend direction to the upside. What I don't think is going to happen is that the Dow and the S&P is going to come back down to 24.5, for instance, or relatively speaking on the S&P down to that relative figure as well. I assume that what is going to happen is that we are going to find support more or less very close to where we are trading at the moment. It may even be the 20 exponential moving average, but the net outcome of this move, even if there is a pullback, is going to be a trend continuation to the upside. So what we can do is just simply place a little bullish entry, and this is going to be a continuational entry. On the diamonds, if you want to jump into the diamonds, it's also going to be relative, or at least relevant to the S&P 500, but the trade setup is going to look something like this: 25,453, which is going to be a break of the swing high. This takes us back to the beginning of this week on Monday, and that's going to drift again, of course, this market on up higher to ultimately close our gap. Now, on the diamonds, I know a lot of people have been positioning themselves and been sort of strategically navigating the waters of option chains on the diamonds that has generally sort of lower open interest or liquidity, so to speak. So I know a lot of people are navigating into the S&P 500 as an alternative, and you can see for yourself that the trend direction, it is still up. Nothing has changed there, but we do not have that of sort of a bull flag under construction, which is what we're sort of seeing on the industrial average. Both chart patterns, however, still have the same outcome. We're still looking at the S&P 500 continuing to trend, and you can see for yourself that in the grand sort of scheme of things in the picture, there is no sort of signals whatsoever to at this particular time to give us any other sort of directional movement. You can see that instead of a bull flag, this is just looking like a stair-step continuation type of pattern. So for those of you who have again kept a cool head during this period over here, if you entered into towards the end of March or early April, or even if you re-added in the early period of May, or even most recently of this green rectangular box, you're still sitting here with a very big smile on your face, and simply you're just letting this market drive on up. But I would recommend pay attention to 2852, and again on the Dow, this upper target area. When we get to this point, that's where we're going to have a serious discussion as to the direction of this market, probably as we enter into the second sort of half of the calendar year 2018, because there is a good chance that we're going to have to sort of move into a more neutral outlook and really just let the market dictate to us whether or not we are going to see a major reversal and potentially a cracking of this bullish trend line here. That is one possibility. Or whether or not this breakout, which is happening on the NASDAQ and also the Russell 2000, is going to be a legitimate sort of macro bullish continuation. I'm still a little bit hesitant to call it as it is, or to call it sort of a large sort of long-term breakout. And the reason I say that is because largely when we look at the Russell, we've had targets on this I keep saying 1,730, but you can see 1,726 on my screen. This takes us back to the end of the bull market in 2007, leading into 2008, and then of course the bottom falling out of the market towards, or at least the early stages of 2009, when ultimately we based. Okay, this is the trend line you should be paying attention to. This is the Russell 2000. If you project that into the future, you can see that we're looking at a back test all the way up here. This is that red line, by the way, if I can just sort of highlight it for you. I know it's hard. There's lines all over my screen, but I can't. I mean, if I remove any of the lines, it's all of them. I can't just simply leave one on my screen without using my sort of Illustrator tool just here as I'm doing. But this is my target on the Russell 2000. When we get to this figure, just to bring this back into perspective, I expect the Russell's going to stop. It's going to slow and potentially reverse. And that may set the stage for the NASDAQ to do the same thing, but also this might align with the industrial average, potentially finding significant resistance up here, just shy of around 26.5, which may lead to a major reversal in the markets. Now, I'm not going to take this discussion any further right now. Now is not the time nor the place. That's going to be sort of discussed in that pro analysis class. So if you want to learn more about that or have more sort of an intricate understanding of what I'm looking at, I'd encourage you again to have a look into that pro analysis class, which I sit down on for about 90 minutes on a Saturday and just go through, and we go through all of the market indices and these top 12 shares that we follow, all right, that I'm sort of giving people an update on at the moment. Now, that's a relatively decent segue into some individual trades. I'm pretty happy just quickly touching on the markets, but above all else, they are still bullish. If we do see a little bit of a pullback, it's going to be most likely in conjunction with a bull flag continuation, and you don't want to find yourself potentially going short here. You'd rather just play the bounce or look for the reversal that I think is going to come, much like the position over here that we took in this stance and the prior warning that I put out at some point over here during this little time frame here. But moving into the individual stocks, I mean, I am going to speak about the US dollar, obviously, and also GLD. But before we get there, let me just move into a couple of other stocks. We've got Netflix, which just continues. So this was a very recent trade on Netflix. We've had two entries, one at 342 and also one at 373. We were toying with one, or the idea, at 319. Personally, I didn't get in at 319. I mean, this was where the bullish continuation should have started, and that's exactly where it did start if you take into consideration where these past two entries have been. Boy, I wish I entered at 319, but I'm pretty happy just playing the 342 and the 373 breakout. You can see it's charging on up to 399. I'd suggest more or less just placing a really tight stop below the low of Thursday's candlestick. And look, if we see this trade on up, I mean, it's trading at 392.87. I mean, if this makes any more sort of dollar incremental movements, I mean, even if it just pops another dollar or two, I just more or less take profits off the table, because I'm assuming it's going to slow down at $400 per share. You may not want to take all of the positions off the table, but at least take a portion and just lock in that profit on Netflix. That's been a tremendous trade. Also Google. Interestingly enough, I've had a lot of emails come in to do with Google, and I'm a little bit surprised as to why I'm receiving these types of emails. A lot of people are suggesting that Google's going to roll over and break to the downside, and I understand why that is. But at the same time, this is still bullish. In the past, I mean, we've really hit the nail on the head with the analysis, coming back up and filling past gaps, acting as sort of targets like magnets, as I've described on the industrial average. What we've done most recently is broken above our most recent target at 1131, and I was saying, well, this is looking like a back test of the trend line. I even gave an example over the weekend of the actual back test underway on the Dow Jones Industrial Average prior to, again, this most recent pop to the upside, which is sort of taking place over the past 1.5 months, just from this point here. So pay attention to the trend line, break above it, retest, and then off you go. And I was just making the parallel between that particular market, the Dow Jones. I know, obviously, Google's more relevant, obviously, to tech and the NASDAQ, but it's the same type of sentiment and psychology behind the overall move. You can get caught up, of course, in differing sort of fan lines or decelerating fan lines or resistance points. Oh, my phone's just going off. Pardon me. I need to put this on silent as I sit down and record. Just hold on a moment. But you can see for yourself that the bull flag mixed with the back test is clearly taking off to the upside. It may not be a legitimate move, but I was interested in this and made it very clear at 1151. We're trading at 1160, so it's only popped ever so slightly, but there's a chance that we're still going to run potentially on Google up to 1189, and it sets sort of the tone, which works quite nicely with the NASDAQ, but also Apple as well. Now, Apple's been stuck moving sideways. It's still holding above that 190.38 entry point, and what you need to understand is that essentially what's going on now is that we might just be replicating that of the stair step that we saw in the month of May. So you see how in May we essentially broke out above 183, 184, and we simply moved sideways, and I was saying just wait for the exponentials to come on up and start interacting with price, and you should see again the continuation to the upside. Well, the bullish trend, for one, it hasn't reversed, and number two, it looks like we're doing exactly the same thing. I know it's not good when you see a market, or at least an indice, show strength and you don't see sort of the participation of an individual stock encompassed within that indice. I get that. I completely understand that. But at the same time, I mean, Apple's moved from 160 at the beginning of May, and we're trading up here at 190. So yes, we are still gravitating towards the psychological round number of $200 per share. But as long as we remain above really 183, 184, 185, and most likely hold up above the 20 exponential moving average, this is something that you just hold on to, and you just don't let sort of the intraday movements persuade you otherwise, really. I mean, technically speaking, at least on the fractal of a swing trade, it's still looking quite good. And I just wanted to make that very clear to people who may be sort of, I mean, obviously a lot of people are interested in Apple. It is very closely and widely followed as well by a lot of people, not only in the United States, but around the world. And it's also sort of a thermostat, or a gauge at least, for, I guess, the health of the US markets as a whole. I know it's not perfect, but at the same time, if you see Apple doing well and markets generally breaking out to new all-time highs, obviously you are in that of a continuation of a bull market. It just depends on what fractal that continuation is. And that's where, again, the bifurcation of the markets, or at least the breakdown and the divergence, which seems to be happening or potentially happening at higher prices, is something that I'm forward thinking about, and just spending a bit of time mentally getting my head around and sort of planning a what to do or what if sort of scenario on both directional breaks that, ultimately one is going to come. But again, that's at a later date. Anyway, I'm still thinking about it and generally thinking about it now. So I don't want to go off on a tangent there. Other than that, we've seen a little bit of weakness in Boeing Airlines. The good news is that we hit our target at 369, but you are seeing a pullback more or less back down to the original breakout point. This is a trade setup, by the way, for the week upcoming. So, this should be welcomed, by the way, by a lot of people. Baidu's just continuing to trend on up. It's going to most likely fill the gap. 264 up to 279. Don't want to speak a whole lot about that. Caterpillar's the one stock under pressure in our list, and it isn't seeing any follow through at the moment. It is pulling back. It was down $1.57. I'm not concerned about this at the moment. If you pay attention to this, we've sold off, and this is what I was just trying to navigate to, was my number 3 key on the keyboard here. If I look down, I've got a microphone in my face, so but you can see we're tagging the 50 again. In the past, we've held this level. It's going to be interesting to see whether or not Caterpillar actually holds this. If you're on the trade, I'd recommend just placing a stop below the low of the last trading session in the month of May to the short-term sort of temporary support just here. But other than that, still relatively favorable on Caterpillar moving forward. COP should have liquidated. I put out a YouTube update on this on Tuesday as at the close and said, hey, if we just move below this, take the profit and just be done with it. This is very similar, by the way, to Boeing Airlines. So these are two trade setups for the week upcoming. So we'll speak about these in great detail. We've got some pretty decent sort of structure forming, and I love these types of trade setups. They may not sort of necessarily break first thing Monday in the week upcoming, but they are going to look pretty decent and pretty healthy when the majority of people wake up to the fact of just simply what's going on, which is good. We've got CVX, personally not in this, wasn't really interested in it at 125. I've recapped Google. IBM, by the way, again, it was one of those stocks where we say, comparatively anyway, compared to other stocks, it's not really a go-to trade. You can make the argument very easily to go long above 146.65. It was either going to be an immediate breakout, or what is most likely going to happen is we're going to get another back test of this green rectangular box before we see again potentially that of this very short-term trend continuation take us on up to close this 156 area. I'll go into more detail with that tomorrow in that pro analysis class. I've recapped Netflix. Tesla's is still taking off. Tesla, I should say, not Teslas. But you can see here above 312. Personally, not in it, not interested. I'm just staying very clear from Tesla. I've been very open about that. Sometimes I wish I'm not as cautious on this particular stock, but at the same time, it has been sort of acting rather irrationally over the past number of months. And generally when that happens, I just sort of gravitate and completely remove myself from that sort of market environment, or at least the environment relative to the trading, the active market participants on Tesla. So not going to say I'm in this because I'm simply not. I know some people are. Congratulations on the trade. 312, it's trading at 357. But look, I'm really not interested in Tesla. And my conviction on this hasn't changed. What we are doing, however, is coming back up to this 360 pivot. So that's something very interesting to note. And we'll see whether or not we can actually change what appears to be that of a bearish trend by producing at least a sustainable higher high. We're still yet to do that. We're very close to doing it. But at the same time, 275 up to 360 more or less, that's a big move. It's got me thinking that we are towards the end of what could be that of a short squeeze and potentially a bunch of supply. Part of me flooding the market up here around 360 and rolling, or at least reversing the movements on Tesla. Now, jumping into a couple of other stocks, we've got FDX. Now, you need to liquidate this. If anyone is in this still above 257, close this out for a profit. Be done with it. We do have earnings scheduled early next week. I simply wouldn't be holding this over the weekend. You should be out of this, or you should at least be considering liquidating out of this trade. Certainly by the end of trade tomorrow, being Friday. All right, just get out of it, be done, bank that profit. See you later, FTX. You've been fun, but this is where our sort of commitment and relationship sort of ends on this particular stock. For now, anyway, we'll see what happens over the coming days and what happens after earnings. I'll give you an update on that. Also, HD. This is something that we've been interested in, the breakout above 191.63. You can see it's tried to continue this week, but at the same time, it's beginning to throw up a bunch of sort of reversal candlesticks. I personally don't think it is going to reverse. I still think it's going to run all the way up to 204.88. We are more or less at that psychological round number. So surprise, surprise, you see it working out again, gravitating around $200 per share. But even if we do see a little pullback, it's probably going to work out with a bull flag continuation if the theme of the market itself, the sentiment behind the market, is still obviously rising and pushing to the upside with those higher targets on the market indices. So you can either take some positions now more or less at $200 per share. That's a very quick $8.40 there. But at the same time, I still think personally it's going to come to 204.88. I am looking, of course, over here to see if this is an open window. It's not. The reason for that is because after we saw the brief sell-off or the very abrupt sort of crash, we closed the gap and then we continued the sell-off. So there's no actual open window to gravitate around, even though it looks like a big open window. That window was closed 2 sessions later. So do as you please on HD. But I think it's a good idea, anyway, just to take some of those positions off and just let the rest sort of ride. Okay, for now on HD. TWX, massive move yesterday. What did I just push? I pushed the wrong key. I'd never seen that before. Hold on a second. Yeah, that was really weird. I had this sort of dark black line trailing price. I'd never seen that before. I must have short-term or temporarily corrupted some data by pushing too many buttons on my keyboard here. But anyway, you can see the same... actually, not HD. I'm trying to bring up TWX. Let's do this again. Maybe that's why. Yeah, there we go. Perfect. I was going to say that chart looks very familiar. But anyway, let's just continue into TWX. Yesterday, we had a mammoth gap up, pretty much tagged $100 per share. The good news is that if you use contingent orders, say you've got an a target established at 97.60 and you get a gap above it, what happens is you actually get triggered out at the market open, and that's going to be, as I said yesterday, about $2.40 above the target. So it's not as if you sell your stock or the options priced at 97.60, which would be a fantastic outcome regardless, but you actually get that extra $2.40 up at the $100 closing price, or at least the opening price. So this has just been another great trade. Yes, we had to hold it ideally a little bit longer than what we wanted. So be it. Doesn't really bother us. Tried to speak about this over the weekend in Pro about just letting things be. Once you find confidence in the trade setup, the DNA of the trade, just to let it sort of settle. Unless that trade just goes against you immediately and doesn't look back, there's no reason to actually liquidate out of a trade. And I'm sort of directing this into Apple, by the way. Obviously, it hasn't moved all that far yet, but at the same time, there's no reason to actually bail on the trade. What is that? I've got a push order for Domino's coming up on my screen. But anyway, you can see just here, inside day, shooting star candlestick. And I mean, you should be out of this, but a pretty decent trade just to recap. I'm very happy anyway about TWX. That's what I have written down on my list. Obviously, I'm going to gravitate around the US dollar surge today, a massive move back up to retest this tweezer top reversal. I'm going to go out on a limb here, even though I don't have a vested interest in the US dollar. I'm not long and I'm not short in either direction in the US dollar. To me, this is exactly what I was talking about. I was talking about the perimeters being set, so to speak, the resistance area and the support area, and how after this tweezer top, we're probably going to see some tremendous volatility. Well, today was a tremendous surge of volatility, wasn't it? We're more or less back up to that high that we established towards the end of May. It's going to be interesting to see whether or not the US dollar can sustainably break out above this level. I will say a major disclaimer. If the US dollar fails around this pivot or very close to this pivot at 95.50, and it produces that of a reversal, well, then we've got the sort of intermediate reversal in alignment with the larger sort of bearish macro trend of the US dollar. And that could be sort of the high price that we price on the US dollar for the foreseeable future. So I know the sentiment right now is extremely bullish on the US dollar, but at the same time, I'm just giving you the warning there. If we do see the reversal take place, the writing's on the wall for the US dollar, because this is exactly where we would expect it to reverse. This is going back to the highs. And again, the consecutive series of lower highs that have been pricing in. This is the chart of the US dollar again since the late period of 2016, and it has been in that of a bearish trend. Now, why are we looking at the US dollar? The reason for that is because when you see, a surge in the US dollar, generally what you should think about is potentially weakness in gold, right? When you see a surge of this magnitude in the US dollar, before I even bring up the gold chart, you'd somewhat expect the price of gold to actually be down on the day. Well, if I bring up the price of gold on the day, it actually rallied. I mean, it didn't rally by all that much, but it was up 20 cents or 19 cents, as you can see in my top right-hand corner here. And I mean, it's sort of rejecting the movements that we're seeing in the US dollar, which is good. It's first of all respecting this trend line. We actually saw a gap up, interestingly enough, at least the 24-hour suspension gap here was to the upside, which is good. And although it was technically sold, we do have an upper wick. the net movement was positive on the session in the face of that mammoth long day white Morobozu potential second retest of what may be that of a double top on the US dollar. So if a lot of people are, what I can say definitively is that people are not willing and jumping out of gold at the moment. It's actually the reversal of that. People are jumping into gold, hence the gap to the upside. So we're going to have to monitor this, but in the face of that movement, gold held up, not only held up, but actually advanced, which is, I think, a very interesting signal. Again, in continuation of what I've been speaking about with the trade setup down here on GLD. Now, if we bring up SLV as well, you can see for yourself what is going on in SLV, another gap to the upside. So this is looking like, I know I've spoken about this in the past, and this is going to round us out as at Thursday. But if I bring up the Bollinger Band, you can see very clearly there is a Bollinger Band break. This is on the daily time frame, but when I go out to the weekly time frame, this is where it gets exciting, because the last time, I mean, honestly, I don't remember the last time that SLV was this tight in terms of a Bollinger Band squeeze, but you can see here that on the weekly time frame, this is about as tight as what we get. And I mean, I'm going back. I mean, the last time, okay, and I don't want to create any falsehoods whatsoever when I speak about analysis or apply analysis or give you my take on the market and just update you on things. But if you look at the width between the top band and the bottom band here, okay, just use your eyes. I know it's not going to be all that clear. I am zoomed out. I'm going all the way back to 2008. But if you just have a look at silver here, all right, and you take it all the way back to 2010, I think just using my eyes right now, going back through sort of the intestines of silver, so to speak. I mean, the last time to me it looks like it was this tight was during this period here. And you know what? It may even be sort of a less width going on at the moment at the current junction. We are only just starting to begin piercing out. So for one, I'm not calling silver to sort of rally like it did off to the blow off top in the beginning of 2011, which has sort of ended the commodity cycle or what has been in a bear market since. All I'm trying to suggest is that this squeeze is going to resolve itself one direction or another. And I'm assuming, given the price of silver being $15 here on the ETF itself, I mean, to me, it seems as though it really cannot go all that much lower. I mean, back in 2009, we got as low as about $11 on the ETF. Okay, and we're only $4 above that at the moment, and this is being priced in 9 years later. So when I look at this on a risk and reward time frame, and again, I'm not trading silver, I prefer GLD. I mean, it still complements our GLD analysis and also our take on the US dollar and potentially that of some cognitive dissonance, so to speak, on behalf of the bulls jumping into the US dollar potentially at the wrong time, the absolute wrong time. I think it's worthy of your attention. And just to bring it back into a more of a molecular level, even if you think that this is sort of extended, so to speak, I would sit here, and I will sit here and I'll share with you, and I'd say, well, maybe it's extended on over the past 5 sessions, but if you go on the weekly chart and look at the Bollinger Band squeeze, I don't think people have seen anything yet. And I think that there's going to be a lot of gobsmacked people just scratching their head as to potentially how high not only silver can go, but GLD can go, not over just the coming days or weeks, but also potentially coming months as well. And I just needed to update you on that again as at Thursday. So I think this is going to do us. I hope that wasn't too long, but at the same time, I felt like we had a bit to talk about. And just to give you, again, a pretty comprehensive snap breakdown of just what's happening. I'd recommend anyone to have a look into that analysis class that I'm going to perform tomorrow. This may also act as that of a weekend address too. So if you're following all the way through to the weekend, or if you're watching this on a Saturday, I won't see you again until next week during the trading session if you're not in that analysis class pro on a Saturday, all right? So I wish you and send you all of my best wishes. I'm going to say farewell. It's James signing off on behalf of Pivot Point Trading. All the best, everyone. Goodbye.